Hello, Smart Money True podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. And today I'm joined with Josh Radman. How you doing today, Josh?
Doing well. Thanks for having me, Kirk.
Good, good. We wanted to bring Josh on because there's a topic we haven't talked much about, but we get so many questions about this. I thought it'd be really important to bring him on. Josh, tell us a little bit about your background.
Yeah, a little bit of an atypical background, but I started actually in consumer products. So I started my career at General Mills. I was there for a little bit of time. Actually ended up meeting my wife there, which is probably not what you care to hear about on the show, but that's what it is. Went to business school at Harvard, which I think is in your neck of the woods, and then found myself at a couple of tech companies, Walmart e-commerce, so probably like one of the biggest, and then a Series B tech company. And it was at these tech companies where I started to get different types of equity grants. So RSUs and ISOs and all these different things. And honestly, it was super confusing. And it was really frustrating and it lit a fire underneath me because I have a lot of really smart, mathy, financy friends. Nobody could tell me how to strategize around my ISOs. Nobody could tell me kind of when I should exercise, when I shouldn't, what I should be thinking about. You can go online and Google AMT and figure out kind of what that means and what the implications are. But it was really, really difficult to figure out what I should be doing. And that was kind of my epiphany moment for starting my company, Presidio Advisors. So I now run an RIA based out of Denver here, and I focus exclusively on millennials with equity comp. And so they tend to come, they find me for, stock comp planning and analysis, tax planning. And I help them, if they're going to have some sort of liquidity event, maybe it's an IPO or it's a tender offer or an acquisition. But yeah, that's a little bit about how I kind of got into this. I'd always been interested in personal finance. I didn't know, I thought it was going to be more of an encore career, like something I would do when I'm, semi-retired, but decided to pull the trigger on this because I felt there was a need. It had impacted me personally, and here we are today.
Nice. Yeah, it's one of those areas that there's so little information out there and wisdom, and yet there's a growing number of companies that are providing this for their employees. And in some ways, it's really simple. In some ways, it's really confusing. So, what are
Totally.
the different kinds of equity comp that are out there that kind of fall into this bucket of equity comp?
Yeah. So if you're at a public company, you're typically getting RSUs, restricted stock units, and those tend to vest over a period of 4 years. That's typically the most common, but we're starting to see companies experiment with different vest periods and that type of thing. So restricted stock units, if you're at a public company, typically with a 1 year cliff, meaning that you don't have a right to any of these shares for at least a year. If you're at a private company, it really depends. Most typically, incentive stock options, let's call them, ISOs, non-qualified stock options, NSOs, or RSUs. The RSUs are slightly different. They're what's known as double trigger RSUs most commonly, although you can have some single trigger RSUs as a private company. And typically, the earlier the stage of the company, the more likely you're going to have ISOs. And then as the company becomes more and more mature, you're going to graduate to NSOs and then RSUs as the company is getting towards their later stage and looking to probably go public or something like that.
So why would earlier stage companies generate ISOs and later companies have non-quals or RSUs? Like what's the
Yeah.
reasoning for that?
Yeah, it's a great question. So when you have ISOs and NSOs, those are options. Options give you the right to buy something, but not the obligation. So you don't have to buy it. Whereas with RSUs, you're actually getting shares of the company, restricted shares, but you don't have to purchase anything. So in earlier stage companies, there's what's known as the 409A valuation, which is basically an independent accounting metric to value the common shares. And the reason why you'll see ISOs at earlier stage companies, but not at later stage companies, is because that 409A valuation tends to be much smaller at earlier stages. And so it's much more palatable for employees to potentially purchase their options. Whereas you can envision, later down the road, let's say you're Series G or whatever it is, Series D, and now your valuation is $5, $7, $10. Well, if you have incentive stock options or non-qualifieds, it's a lot more, it's much more difficult to actually be able to come up with the cash and the liquidity to purchase those shares. And so as kind of a way to incent employees to stick around, the employers tend to start to provide RSUs because there isn't a cash outlay. There are other reasons too, but that's a big one.
Okay, that makes sense. I was always curious about the ISOs versus the non-qualifieds, though. I mean, it's basically the
Yeah.
same thing, just different tax consequences. And I would think everyone should want ISOs because you don't have to do it, right? I mean, it doesn't change much. You don't have to do the planning element to that, but it's nice when you get it.
Yes, it is. And there are, the ISOs and the NSOs, there are, they often require a lot more advanced planning because of the tax implications, particularly the ISOs. If we're going to, go down that rabbit hole, there's, disqualifying dispositions and qualifying dispositions, and they can potentially trigger alternative minimum tax, whereas the NSOs are a lot more straightforward, typically taxed as ordinary income when you exercise, and then capital gains. But the RSUs are sometimes nice because they're simpler in a sense. There's still a lot that you have to do to plan around it, and you have to understand, and there are a lot of watch outs and risks involved if you're not careful. But the options are really where it's like, okay, let's think about kind of your individual situation and figure out how we want to optimize here.
Yeah, no, totally agree. Um, so let me ask you this. I mean, there's obviously a lot of different ways that companies can compensate their employees. Um, why? Well, maybe that's a bad question. What I find is a lot of employees are not really knowledgeable about this equity comp, and I
Yeah.
find that some companies just generally aren't educating them on it. They just give it to them and just say, "Here you go." Like, is there a
Yeah.
reason why companies aren't doing a better job educating their employees? Because I would think they'd want them to know what this great benefit is they're giving them, but yet a lot
Yeah.
of employees have no idea what it is.
Yeah. I don't think it's by design. I think, and by that I mean, I think a lot of companies they do want their employees to understand what's going on. They want to do well by their employees. They want to reward them for doing good work. But there's this really fine and often gray line between educating employees about the tax implications and giving tax advice. And the legal departments are all over these companies to make sure that they're not crossing that threshold of giving tax advice, because they don't want to be, on the hook for that. And that's very understandable, but it leaves this huge gap, for employees to try to figure this out all on their own. And it's super complicated. And there are a lot of, nuanced dynamics when you go from company to company. There are obviously, the IRS laws, but every company, when they're doing a liquidity event or when they're having a tender offer, the devil is really in the details. And so it's not as straightforward. And I think that's where I kind of, saw the white space here, and I shouldn't even say white space, but just the gap, because I was so frustrated myself with like, hey, nobody can tell me what to do here. That I decided to basically dedicate my career to helping educate others and really give them confidence and clarity in their financial plans so that they can sleep better at night, because a lot of their net worth is often tied up into these equity packages.
Yeah, I agreed. I mean, if when you go to work for a company because of the benefits package, and then you don't really optimize it because you don't really understand it. I remember one situation when I first started in '99. I was sitting in the bullpen back then because they still had those, and I was sitting there and was next to a guy, and he was working with this tech guy. I don't know, he was some tech company locally. Anyway, I think this was actually in 2000. So it's when the stock market started to pull back and tech stocks really started to get crushed. And what he had done is he had basically he had ISOs. So it was kind of like an exercise and hold a year, and
Yep.
he basically turned a close to $1 million in potential profit into a huge tax hit and very little money to pay it.
Yeah. Yep.
So we don't really see that as much now because the markets aren't crashing in tech, but it's so maybe we can talk a little bit about ISOs so people can understand the risks, the rewards, and some of the challenges with them.
Yeah. The first thing I'll say is just on that story, something I always tell clients is don't let the tax tail wag the investment dog, right? Like when we're talking about ISOs, when we're talking about NSOs, everybody wants to first jump to, okay, how do I optimize for taxes? But the first decision that you have to make is an investment decision. Is this a company that you want to bet on and that you want to, put your capital into? Because that's what you have to do first and foremost. When you are buying company options, you are, essentially saying goodbye to that money. You have no idea when there could be a liquidity event. Maybe you're lucky. Maybe you do know that there's a liquidity event coming up. But typically, you're putting it all on black or you're putting it all on red. And so you have to be super confident in that plan. The other thing that you have to think about are all these kind of unique circumstances or things that could impact you. So, what are your financial priorities? What's your risk tolerance? And not only what's your risk tolerance, but what's your risk capacity? You may want and you may think that you can take a lot of risk and that you can stomach all the volatility that comes with private companies, but you may have a mortgage that you need to pay, or you have childcare that's running you 20, 30 grand a year, or you need to buy a new car, or all these other priorities that would honestly take precedent over putting you buying your company options. And so you have to think about that. And then you have to think about, your concentration risk. How much concentration risk do you have? What's the cash outlay required to do this? And if I do exercise, we're talking about ISOs here. ISOs are one of the unique types of equity that could potentially generate alternative minimum tax. And so we're starting to we're getting into the weeds, but I think my point in saying this is that there are a lot of quantitative and qualitative components to deciding whether or not to purchase your equity, particularly your ISOs and your NSOs. And that's a very personal decision that needs to have a lot of discussion and back and forth between you, your significant other, whoever it may be.
Yeah, I find that most of the conversations that we have with clients that center around equity comp options, the confusion or the frustration, it typically comes down to a few different points, which is risk versus reward, right?
Yeah,
Like, you can take $500,000 now. It might turn into 2 million, or it might turn into zero. Like, which one are you going to take? Like, I don't know. What do you think I should
exactly.
do? Like, I don't know what the stock's going to do. So,
Exactly. And I think one of the ways that, there's no right answer. Like there's no one way that's accurate. But an exercise that I like to do with my clients is, around regret minimization. What would you regret least? So one option is you put all of your money into, company XYZ that we think right now has the potential to go to the moon. And you put in a ton of cash, and in 2 years it goes to zero. So that's one outcome. Or you end up leaving your company or whatever, you decide not to exercise your ISOs, and so you have nothing. Basically all that blood sweat equity that you put into your company is gone, and then in 2 years you see that your company has gone to the moon. What would you regret more, or what would you regret less? And that's often the very personal decision that folks have to make, because you're going to be disappointed either way. Like it's very rare that you are never going to have any regrets. So we just need to think about what you would regret the least.
I think it's a great way to do it. I never heard that term before, but I love it. Regret minimization.
Yeah.
Yeah, I think it's hard for people to put in perspective regret, because it feels like, like, oh, I lost out. I mean, I guess if the company goes to zero, maybe you regret it less because you're like, well, whatever. I went to zero. It is what it is. But I find, like, it's basically fear versus FOMO, right?
Totally.
I mean, FOMO is a real thing in our society where people are constantly worried about, like, oh, I missed out on this. Like, if I bought this company, I didn't sell half my position, think of all the money I'd have. I'm like, yeah, but you didn't. So,
Yeah. Yeah. And that's why I think so much of the initial upfront conversation, needs to happen ideally like a year in advance, because when people start to get into like really close to their IPO stage, or some sort of liquidity event, you can't really think straight, right? There's like a decision fatigue that comes along because you suddenly now have to make so many decisions in such a short amount of time that everything starts blurring together. Everyone and their mother has an idea of what you should be doing. You're hearing chatter, on your company internal channels, at the water cooler, wherever. It becomes extremely overwhelming. And so it's super important to kind of lay out this plan up front and to think about the FOMO that you were talking about, and like, what are our goals here? What are we optimizing for? Where do we want to be? And so I like to kind of, my approach is, if we're talking about regret minimization, is let's start with your purpose. Like, what is important to you and what's important to your family? What are the big life goals that we want to accomplish? Is it we want to buy a house? We want to buy a boat? We want to send our kids to college? Like this could be life-changing money, and we need to think about how we, what's enough and how much risk we want to take. And then we start to develop the financial plan. How much risk can you actually take? Like, and how do we deliver that in a tax efficient way, of course? And only after we talk about delivering or like developing the financial plan can we then start to talk about what is the path forward. And I like to assign a job to be done for every dollar that clients have. What is the specific purpose of this dollar? Because the purpose of that dollar is going to dictate how we invest it, how much risk we take, whether or not we purchase the options or not, all that type of stuff. And those strategies need to ultimately serve, your overall goals.
Yeah, totally agree. So let's talk a little bit about taxes, everybody's favorite topic.
Oh yeah.
And because each of these parts of the equity comp, I mean, a lot obviously has to do with taxes, right? I mean, profit's profit, but you want to minimize taxes because it's really your net profit after tax that's really the result. So can you talk a little bit about the tax implications for each and decisions and how that kind of plays in?
Yep. So let's start with ISOs, since we're on ISOs, and then let's go to NSOs and RSUs. So what folks need to know about ISOs is they, and I guess there's three different stages. There's vest, there's exercise, and then there's sale. When ISOs vest, they are not taxed. So nothing is happening when your ISOs are vested. When you exercise them, the tax, you will either be subject to AMT, which is alternative minimum tax, or you may actually be under this threshold where you don't owe any tax. So there's actually like let's call it a free window where you can exercise up to a certain amount of ISOs every year without being subject to alternative minimum tax. That tax is based upon the spread or the bargain element, the same thing, of the 409A, which is the fair market value of your private company at the date that you are exercising, less the strike price. The strike price is your grant price. So if your company is worth $10 today, you had you were granted ISOs at $3, then your bargain element, the spread, is $7. The tax implications are based upon the $7 times the number of shares that you are exercising. So that's on the ISO front. And ISOs, by the way, generally, they're the only type of equity that trigger AMT, alternative minimum tax. And then when we go to sale, it depends on whether the ISOs are either a qualifying disposition or disqualifying disposition. We can talk about what that means. But you are going to be subject to capital gains tax, either short-term or long-term. The other thing I'll add here is alternative minimum tax can be recouped in future years. So it's often known as like a prepayment or a kind of, prepayment tax, I guess, because it is recoupable. And so that can be an important element here in terms of tracking your AMT from prior years so that you can recoup it in future years. That was a lot. And for listeners, that's the most complicated one. ISOs are definitely the most complicated. It gets easier and easier as we start talking about NSOs and RSUs.
Okay. So simply put, you exercise your ISOs and you wait a year for long-term capital gains, and then you get taxed at long-term capital gains once you sell it after a year.
Yes. So yes, the qualifying disposition, to get super technical here, is there's a 2-year rule and there's a 1-year rule. The 2-year rule is the stock has to be held for at least 2 years from the grant date. And then the 1-year rule, this is in addition to, so both have to be true. The 1-year rule is that the stock must be held for at least 1 year from the exercise date. If both of those rules are true, then you have a qualifying disposition and you're paying long-term gains tax on the entire spread. If not, you're paying some capital gains tax. It could be short-term, it could be long-term. The rest is going to be ordinary income.
Okay. So the idea is you want to have it 2 years from when you got the grant, and then 1 year buy and hold,
From
and then you
exercise.
get, okay. And that's really long-term capital gains at the moment. That's the best tax treatment you can get for most of these
Correct.
plans,
And
right?
generally, long-term capital gains 0, 15, or 20%, whereas ordinary income goes all the way up to 37% right now, excluding some of the the other tack on additional taxes too, net
Okay.
investment income tax, that NIIT, that type of thing.
All right. And then non-quals are basically the same as if you have a disqualifying disposition. So basically non-qualified stock options are, you're just getting taxed as income.
Correct. So again, when they vest, not taxed. When you exercise, you are going to pay ordinary income tax on the spread between your 409A, that fair market value at the date of exercise, and the grant price, the strike price. And so that for sure is ordinary income tax. And then when you go to sell, because now you've exercised, you bought it, when you go to sell, you're going to pay capital gains, either short-term or long-term.
Okay. But you can exercise that and hold it, and then you pay tax at the end.
Correct.
Okay.
Correct. So you exercise, you hold, you're going to pay ordinary income tax. And then ideally, and again, this is where we have to talk about, is it worth holding on to the NSOs and taking that additional investment risk if I can sell them now, but maybe I get taxed at a short-term capital gain? Or can I ideally hold these for longer than a year and 1 day, sell them at a long-term gain, at a long-term capital gain rate, recognize better tax treatment? But again, you could have better tax treatment, but if it's a lower value, then you're ultimately going to have less profit at the end of the day. So going back to, don't let the tax tail wag the investment dog, this is an important one to consider too.
So with non-qualifieds, why exercise at all? We just hold on to this. You have zero risk if you're just holding on to the option, and then you exercise when you're going to sell. Like, what would be the benefit of holding?
So if your 409A valuation, for example, is expected to continue to go up, that means you have a greater tax liability. So let's take the extremes here. Let's say that your strike price, the amount that you were granted, the price that you were granted at was $3, and the company is currently worth $3. If you exercise today, the spread is 0. So you're actually not going to pay any ordinary income tax. And then you hold it, you start the clock for long-term capital gains. You can sell it after a year or so, and then you pay capital gains tax. Let's say you don't exercise today and your company's doing really well. And now the 409A valuation has shot up to $10 a share. Well, now if you go to exercise, you're going to pay ordinary income tax on that $7 spread. Whereas if you had exercised earlier, you wouldn't. But if you exercise earlier, you have that investment risk. So there's a trade-off there. So that is one reason why folks would decide to exercise earlier rather than later, but very circumstance-based, especially in later stage companies when there might be a pretty big gap between the 409A and the strike price.
Yeah, it's interesting because, I mean, one of the challenges obviously is some of these times you have to put up your own money, right, to exercise
Oh
the
yeah.
stocks. And so, it's like, hey, do I put up my own money that I didn't get from this stock yet because I haven't made any gains? I'm putting up my own money to benefit from the taxes. So how do you kind of walk people through that framework? Because that's obviously a big deal. Like, you're actually, it's a greater risk because you're putting money that wasn't from the company given to you. It's actually hard-earned money that you're putting into the company to take this other risk. So how do you kind of walk people through that?
It's a huge deal. And it becomes an even bigger deal if you're about to leave the company. Because often what people don't realize is that when they leave the company, they have what's known as a post-termination exercise period. And most often, that exercise period is only 3 months. So that means that if you're laid off or if you decide to leave on your own, you have 3 months to come up with the cash to exercise these options, or they're gone. And so that is a big pill to swallow, especially if you've been at your company for a couple of years, a few years, whatever it may be. You've earned a lot of this equity, but you haven't yet paid for it. You have to think about how to come up with that cash. And so, again, when you're potentially leaving the company, and there's a lot of turnover in tech. There's research out there that suggests that most folks won't make it to even 3 years at their one particular company. And so, they still have equity there, but they have to figure out how to come up with it. So, getting back to your original question of how do you think about coming up with the cash? I think this comes down to, again, what are your priorities? Like, what's your purpose? What's important to you and your family? And what are your goals? And we think about that. And what I do is I like to bucket these goals with my clients into 3 different buckets. First is short-term goals. The short-term goals are often, what is the cash that we are for sure going to need in the next 12 months? Maybe it's a AMT liability that we have to pay because we exercised our incentive stock options. Maybe again, it's daycare or a mortgage or a car or a wedding or whatever it is. We have to think about that. And then there's also kind of the midterm goals. What cash are we going to need in the next 2 to 5 years? And then long term, generally 7 to 10 years plus. When we look at those 3 goals, then we can get a sense of what is your cash flow, how much risk do we want to take, what's your risk capacity, that type of thing. And that's really where we start to have the conversation of, is it worth us, plunking $30,000 or $40,000 or sometimes, hundreds of thousands of dollars into these options, or do we need to look elsewhere? There are additional kind of, I would say, last resort options. There are financing opportunities. There are sometimes secondary markets that we can look into, but it's very circumstance based.
Yeah, no, makes a lot of sense. All right, so let's talk about non-quals. I'm sorry, not non-qualifieds.
RSUs.
Restricted RSUs. Yeah. So what are the tax implications for RSUs?
Yep. So the tax implications for RSUs are the most straightforward. Basically, when your RSUs vest, and let's assume you're at a public company, and so there's only the time bound or the single trigger, so to speak. So for right now, let's assume single trigger. When you hit that, let's say 1 year mark or whatever that cliff is, they vest. Those RSUs are automatically taxed as ordinary income. Because they are shares, you're not exercising or purchasing them, which is a benefit because you don't have to come up with a cash outlay. And then when you go to sell them, you're selling them at a capital gains tax. RSUs are interesting, Kirk, because I think that there are a lot of folks think that they have a good sense of how these work, but there are so many I would say misconceptions about RSUs that this is worth getting into, especially because folks at public companies they have them, but they're actually not optimizing for their RSUs in the way that they should be.
All right, well, let's talk about that a little bit. So just to clarify, so RSUs, you get it at $100, you're taxed as $100 as income, and then it grows to 150, and then that $50 is taxed at capital gains, right? Correct?
Correct. Exactly right. But most people think, to your point, that they actually have to hold the RSU for at least a year in order to sell at 150 and be optimally taxed. But they don't realize that they've actually already had that ordinary income tax withheld from their RSUs upon vest. And so, that is the biggest misconception is, oh, I need to hold my RSUs for at least 1 year post vest to realize tax efficiencies. It's false. Because the money's already been taken out. If you sell it that day and you don't have a gain, there's no additional tax. You can reinvest that into a broad S&P 500 index, and you basically have more diversification. You're not paying any more tax.
But if there is a gain, in that example, that $50 gain, is that something that's always short term, or is that also, could that be long term capital gains?
No, that could be long term, but if
Okay.
you are holding onto your RSUs, and we can talk about a framework for whether or not to hold onto your RSUs, but if you're holding onto it, you're basically taking uncompensated risk
Right.
because you're not diversifying out. You've already paid the taxes. So you are betting on this one company to perform better than the broader market.
Right. Which I guess if you're the CEO, you probably are okay with that. But if you're an underling, you may not be.
Yeah, and the research is pretty unequivocal in that it's almost always better to sell your RSUs. The question that I like to ask clients is if your so let's say you work at any random public company, Microsoft. I'll just pick Microsoft because it's I don't know why. No reason for using Microsoft, but let's assume Microsoft. The question that I would ask folks is if Microsoft gave you a $10,000 cash bonus, would you go out and rebuy Microsoft shares with that $10,000, or would you use that cash for something else? Most people would say, no, I'd take the cash and I would, do something else with it, whatever it may be. If that's your answer, if you say you would use the cash for something else, you probably should sell your RSUs. And the reason for this is because the outcomes are identical. So if you have $100,000 of RSUs that vest, when they vest, your company, let's say, is going to take out $30,000 worth. So 30%, 22% state or 22% federal, 8% state. They take out $30,000. You're left with $70,000 worth of RSUs. If your company gave you $100,000 in a cash bonus, they're going to give you $100,000. They're also going to take out $30,000, 22% federal, 8% state. You're left with $70,000 in cash. It's the identical outcome. But most people end up holding onto their RSUs for far longer than they should. They end up taking on this concentration risk, and then they end up with a lot more total exposure than they should, and they underestimate how much exposure that they actually have to the company.
Yeah, no, that makes a lot of sense. I like that way of thinking about it. All right. Well, I know we're gonna have to wrap it up here in a minute, but anything that you feel like we missed that we need to discuss in this, because then we discussed a lot of different parts of this. But maybe some behavioral traps that people come into. But what are some things that you think people need to know?
Yeah, a couple of things. Let's talk about the behavioral traps. There are a few other things on RSUs that if we had another hour or so, we could get to. But I think people often forget that human beings, including ourselves, we're irrational. We don't always think rationally. And that leads to a couple of different risks. One is something I just mentioned, which is underestimating total exposure. People have explicit risk, which I think they understand. Those are your vested RSUs that you've been working towards and have vested. They're no longer restricted. But you also have implicit risk. The implicit risk here is the fact that you probably still have vesting RSUs and you have a job that's tied to the performance of your company. So between that, those implicit risks and the explicit risk, you have a lot of exposure to your company, and you need to think about whether or not you have the right amount or if you have too much potentially. The second thing that I would say people need to think about is, we often disregard some of these cognitive biases because we think that our company is the best thing since sliced bread. Like, oh, we're going to go to the moon and we have the best engineers or we have the best AI chips or whatever it may be. I would challenge you to think whether or not your insider knowledge is actually blinding you to external realities that you haven't thought about. And I think there's also this is a psychological phenomenon known as the endowment effect, where we value things that we own more than things that we don't. And this totally applies to RSUs. It's often a huge mental hurdle for people to get people to sell their RSUs because they value their RSUs more than if they didn't have them. And so that would be the second one. And then the last one here, Kirk, is I think people often forget that market returns are generated by outliers. There's a lot of data out there that basically says, we think that the market is normally distributed. Let's assume like half overperform, half underperform. But in reality, it's really heavily skewed. Only a small minority of companies end up generating gargantuan returns. The rest heavily unperform or underperform fairly substantially. And you don't want to be, caught in those companies that are not performing well. It's much better to diversify out. And so those would be kind of my concluding thoughts on some of the behavioral traps and things that people need to be aware of.
Yeah. So the result here is go work for one of those 7 companies and you'll be all set. Otherwise,
Yeah, you'll be set. But even for those companies, I would probably, generally speaking, obviously, it's probably good to diversify out. Would you put all of your equity if you work for NVIDIA into NVIDIA? I don't know. I mean,
not
there's a lot of
today.
risk there. Yeah,
Maybe
exactly.
a few years ago I might have, but even then
Yeah,
you
I
wouldn't
mean,
have because you wouldn't
hindsight's
have
2020, right?
known.
But yeah, it's interesting.
Yeah, no, absolutely. Well, Josh, I really appreciate you coming to the show and sharing your wisdom with us. It's a great topic. We need to talk about it more. Where can people find more about you?
Yeah, people can visit my website. It's presidioadvisorsllc.com. If you're, I also love to just do lunch and learns with folks on equity comp because I was once at the other side of the table and struggling to understand some of these things. So I like to go into different companies and just, take an hour and answer questions on these topics. No charge, nothing for that, no expectations, no strings attached. But I like to do that because I feel like it generates goodwill and puts a little bit of positivity back into the world. So you can reach out to me, presidioadvisorsllc.com, and you should be able to find me, or on LinkedIn.
Nice. Awesome. Well, Josh, really appreciate you joining us. We'll have you back on in the future because equity comp's not going away. So
It's not going away.
really appreciate you coming on the show.
Awesome. Thanks for having me, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Josh. Really appreciate him coming on the show and sharing his wisdom with us. Now we're into the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Hi, Kirk. How you doing?
Doing great. Well, it's just me and you today. We had Megan's out doing some family stuff for a few weeks, so it's just you and me for the panel. But we'll get back into the group session in a few weeks. So so Barb, what were some of your takeaways from the interview?
I wish I had stock options to worry about. I think the stock options are an issue because, especially living in Silicon Valley, where I have contact with so many people with a lot of stock, you really have to link that up with the diversification of your total portfolio. And I think it's really important to figure out how much of that company's stock do you want to hang on to. And so I think we really need to get into talking about what does a diversified portfolio look like?
Yeah, no, that's a great question. So actually, since you set yourself up for that one, Barb, what does a diversified portfolio look like? A well-diversified portfolio?
Wow. Okay. Well, in general, the conventional wisdom is that, first of all, if you own funds, ETFs or mutual funds, then you are very well diversified, because in every fund, particularly if you own like an S&P 500 fund or an international fund, you have thousands of stocks within that fund. So you can literally own a couple of stock funds or one stock fund. Warren Buffett loves the S&P 500 stock fund, and be perfectly diversified across the United States. Now, in general, my belief is that you need some stock allocation to the US. You also need stock allocation to the world. Whether you want to delve into going into different niches, small caps, value stocks, growth stocks, that's up to you. That's a personal matter. There's no right or wrong answer. And then most people need some fixed income, because I don't know about you, but if the stock market does fall 40%, I don't want to be 100% in stocks. That is just, if I have $100,000 one day and $60,000 the next, I'm not going to be happy. Whereas if I have a 60-40 portfolio or 80-20, 80% stocks if I'm younger and 20% fixed income, then the stock market falls, but hopefully those fixed income bond assets are going to hold up. And so I will not experience the full negative impact of an all stock portfolio.
Yeah, it's interesting. I think, if I think back to when I started, diversification was the rage, and it was about educating people that they should be diversified. And this is back in the late 90s when people wanted to put 100% of their money into tech stocks, all tech all the time. And of course, we know how that ended up. Tech stocks, I think the NASDAQ went down like 70% or something like that, something crazy. But it's hard to want to put money in bonds at a time when stocks are going up like 100% a year. Like, it's hard to make that argument. And it's the FOMO that sets in. Now, back then, when diversification actually came out as a theory, it was actually an academic thing where somebody had come up with this, thesis that, if you diversify, you'll get a smoother ride. It wasn't better performance. It wasn't really less risk, although they say less risk, but it's not really less risk. It's really less volatility. And so it came out, and Wall Street's like, hey, this is a great idea. Let's sell this to the masses. This is a great marketing tool. And they did, and everyone came to believe it. And in most parts, it's true, but I think it's misconstrued in some ways. The major way is it's a way to manage your risk. It's not a way to manage your risk. It's a way to manage your volatility. Because if you're like 10 years old and you've got another 80 years to go on your stock portfolio, let's say, or let's just say you've got 10, 20, 30, 40 years, whatever it is, if you got a long time to go, over time, stocks have proven themselves to be the best performing asset over like 100 years, right? And so, best performing securities assets, let's put it that way. I mean, you could say there's other assets, but in terms of widely adopted securities, the stock market, or the index, if you will, is the best performer over bonds, commodities, cash, other things. And so if that's your comparison, say, why would you possibly diversify? Right? That's an honest question. If you're going to get, I'm just making these numbers up off the top of my head. If you're making 15% a year in stocks, you're making 7% a year in bonds, you're making 3% a year in cash over a 50-year period, why wouldn't you just put it all in stocks? Right? That's an honest question to ask. So Barb, why shouldn't somebody not, if you've got a 50-year time horizon, why wouldn't you put 100% of your money into stocks?
First of all, past does not guarantee the future. So over the past, clearly, Kirk, 15% a year is
I made that up, by the
Unlikely.
way.
I
Yeah,
know
I
you
made that up.
that
Yeah.
up.
Yeah, it's
But
probably more
if
like
we-
7, but that's okay.
If you use historical figures with dividends reinvested over the past 125 years, stocks have averaged about a 9% return annually. But there have been periods like you talked about the first decade of the 2000s. Well, because we had a huge overvalued stock market at the end of last century, stocks fell significantly in 2000, 2001, and I also believe maybe even 2002 to yield in the first decade of this millennia under 5% return annually. And I think it was more like maybe 3 or 2. Don't quote me on this, look it up yourself. So there can be periods of a long time of underperformance. I think from the 1930s to the 1950s, the stock market was pretty flat. So look, if you don't have an end date, and if you are going to live forever, or if you have a 50, 75-year-old time horizon, and you believe that US and global companies will continue to grow, then by all means, 100% stock portfolio. But most of us have a much shorter time horizon. Many people don't even start investing in their 20s. Many people don't get into investing till their 30s or 40s. And then you're talking about, 3, 4, 5 decades. So 2 things to consider. 1, how much can you stomach a drop in the value of your investment portfolio? So regardless of how old you are, if you cannot tolerate a 30 or 40% drop in your investment portfolio, you should be diversified, okay, regardless of your age. And the more queasy you are and the older you are about asset price volatility, the more fixed income assets you should have in your portfolio. And Kirk, you and I were talking about this a little before the show, which is that, bonds are important because bonds and cash, because in most cases they're negatively correlated with the stock market. And so when we do have a big drop in the investment values of your stocks, the bonds and the cash will be a little bit of a hedge. So your overall investment portfolio will not drop as much. Now, you won't get the stellar highest potential returns, but you also won't get the negatives of the huge drops when an all stock portfolio crashes.
Yeah, it's interesting because I think most people just kind of don't put much thought into what it really means with a diversified portfolio. And I think there's a few parts here that people need to keep in mind, some of which Barb talked about. So one of those contexts is most people looked at like 70s, 80s, 90s period, and they looked at it and said, oh, well, bonds are a great way to diversify against stocks because when bonds go up, stocks go down and vice versa, so it balances it out. That's not risk management, that's volatility management, first off. Second of all, that from like 81, I think it was, until basically a few years ago, bonds made money. I mean, they dropped, the yield dropped over time over that, 30-year period. Bonds dropped from like 20% down to like 0. And they dropped in yield, which means the price went up, which means that your bonds were making money every year. And so they were low risk, quote unquote, because yields are dropping. But as soon as you saw 22, when yields went up, 30-year bonds dropped 50% or more in some cases. I mean, they dropped a huge amount. And so if you thought you were safe in bonds, you lost half your stuff. It wasn't quite safe. So I would say the thing to consider is if you are looking at diversification for the sense of you're trying to find safe bonds, bonds are not always safe. They're safe when yields are dropping. Right now, the Fed is talking about lowering rates a lot, so their trend is down with rates. Now, if inflation picks up, all bets are off. But the Fed tends to not bounce around a lot. They tend to be more of trend. Once they set the trend, it's going, and you can consider for the foreseeable future that the trend is going to be lower, not higher. So assuming that's the case, which I think at this point it is, then you could consider bonds are safer because the yields are dropping. But if yields start going up, they're not safe. And so I think what people need to consider is the diversification approach is really volatility management, not risk management. Risk management is making sure that your stocks don't go to zero, right? It's making sure that you don't invest in a stock that has a 200 PE that you may never get, never get your money back, right? If you look at, I think it was like Cisco, I think it was, that peaked out in like 2000 or late 90s, and it still hasn't exceeded the price 25 years later. That's risk. You lost 25 years of compounding. Now, it might be a good company. You might like them. You might like the dividend. I don't care. I'm just saying if you bought it whenever the peak was, there's January of 2000 or whatever it was, you bought at the peak and you still haven't, I don't know what the price is now, but like $100 and now it's at 50, you haven't made your money back. You've lost money for 25 years, which means you pretty much lit it on fire. That's risk. Even if the company grows over the next 20 years, that's fine. But until you make your money back, you're not even making money. Like you has to get to that peak and then get higher, and then you're making a little return. So when you buy it is really important when it comes to risk. Risk is what I refer to as the permanent impairment of capital. And part of the permanent impairment of capital is if the company goes bankrupt or if it loses huge amounts of value and never comes back, that's a permanent impairment of capital. Another permanent impairment of capital is time. How much time did you lose? So it went down. How quickly did it come back? Because recently, the stock market has come back rather quickly, and it's shocked most people who've been around for long enough, like COVID. How we were up positive for the year is beyond me, because there's no way that should have happened, right? We should have been down 50, 60% in COVID, and it wasn't. It was end up positive. And so, it boggles the mind of a rational person, but that should have been a permanent impairment of capital, period. And it wasn't. But it doesn't mean that one's not in the future. Look at Japan. Japan's stock market peaked out in 1990, and it didn't exceed that peak until I think it was last year. It was basically 35 years. Let's call it 35 years. It took for them to actually break even. That's a permanent impairment of capital. If you put your money in when you're 20, and now you're 55 and you need it for retirement, well, yeah, now you get your money back, but it's eroded over time because of inflation. So now that money's worth a lot less. You might as well kept cash under your mattress. So the understanding of risk, it really needs to be clear what risk is. And most people don't understand risk. They just assumed, because Wall Street parrots this every day, diversification, diversification, diversification. It can work if you do it right. But if you actually read the academic paper that originally came out about diversification, what it says is not diversification of assets. It's the diversification amongst non-correlated or low correlation assets so that they're not related to each other. That is the point of diversification. It's not put some in stocks, put some in bonds, put some in commodities because, hey, that's what everyone else is doing. It's if all these things are correlated, like right now, stocks and bonds are, for the last few years, have been highly correlated. That doesn't do you any good. You'd be better off just putting it all in one, and you're going to get the same result or similar result. But that's not what you want. You want to find unrelated, non-correlated, or inversely correlated or low correlated assets. Unfortunately, most assets have a high correlation, so you're not really getting diversification you want. You might as well just pick one and just put it all in red. And that's not what I'm suggesting, but that's kind of what a lot of people do. So understand diversification before you do it. And most people who have a 401k are just like, oh, I'm just going to pick 3 or 4 funds and put them in there and go to town. You can do that, but just understand what you're doing. And it's hard because the concept of diversification, the process of diversification has gotten much, much harder because everyone's doing it. So I don't know your thoughts, Barb, but people have a lot of other challenges here too, diversification and, what other types of investments should people be considering if they want risk management or diversification?
You brought up some really good points. And what other types of investments? Well, the key thing that Kirk mentioned was the low correlation. And the correlation, and that means a low correlated asset would mean like if stocks go up, bonds go down. And so that way you have one asset balancing out the returns of the other asset. So the question is, are there other ways to impact the volatility? And what Kurt also was mentioning is standard deviation or volatility of assets has been equated with risk. And it is not risk, it is volatility. So, what other assets? Well, this is a tough one because there are those that believe getting into private investments, alternative assets will lower the volatility of your portfolio. I got a question the other day from someone who has a stock and bond portfolio, and they were like, well, don't I need other types of investments as well? And my answer to that is not necessarily. Okay, other types of investments like private investments, which typically are only available to accredited or wealthier investments, they have the potential for very large gains, 15% or more. But on the other side, the majority of those private type investments require long lockup periods, which means you can't go on the market and sell it tomorrow. You've got to tie your money up for years, 5 years and plus. So that's a disadvantage. And also, as we've all heard, if an investment has a possibility of a very high return, well, that doesn't come for nothing. There's also the possibility that you are going to lose a lot of money. And so I'm not saying don't invest in alternatives, private investments. They can provide another layer of diversification. But you can do just fine without those types of investments. And over time, and this is the key, in the short term, it's anybody's guess. 2022, as Kirk mentioned, when stocks and bonds went down, that was an anomaly. It hadn't happened for 50 years. Could it happen again this year? Sure. But it's probably unlikely. And the question is, if you add in some alternative investments or private investments, is that going to make your portfolio grow more or be more stable? Maybe, but maybe not. And we have data for a very long time for stock and bond portfolios. And that data has shown us, and then that's all we have because we don't have a crystal ball, has shown us that over time, a stock and bond portfolio is less volatile. That means less. Look, we don't care about upward volatility. We love that when the price of our stocks and bonds go up. But it tempers the drops, the declines in the value of our portfolio over time. If you have something that a goal, a financial goal that you need the money for in the next couple of years, don't be in stocks or bonds. Be in a high yield cash account. But if you're investing for retirement, for your kids' college fund, anything more than 7+ years away, it's likely if you have a stock and bond portfolio, maybe some real estate ETFs, maybe not, because REITs are included in the S&P 500, you'll be fine. You'll get a better return than cash. But Kirk, there's another thing I think we need to touch on, which is we've talked about balancing out the risk. We've talked about the difference between volatility and risk. And I want to put another twist on risk, which is the money you need going to be there when you need it? That's risk, running out of money, which leads us into the question of asset allocation. What is that? Why does it matter? And I'm going to turn that topic over to you, Kirk.
Well, actually, you mentioned something really quick I want to touch on, Barb, which is upward volatility. So you had mentioned in your talk how people are concerned about volatility. They don't worry about volatility when the market goes up, right? It's only the downward volatility, but that's only half the equation. So if you're talking about volatility, volatility is up and down, not just down. But we don't worry about the up because it's making money. But I want to point it out because it's like looking at half the equation, just saying, I don't understand why this doesn't make sense. It's like, well, if you look at history, and I love this Wall Street marketing piece. It's like, well, if you miss the 10 best days in the market, your average annual return would be dropped by like 10% a year. And wow, that sounds great. I should keep all my money in the market, right? Well, what they don't say, it's the Sherlock Holmes story, A Dog Not Barking. What they don't say is, first of all, if you miss the 10 worst days, you would have done much better than all of those. Well, obviously you want to miss the 10 worst days, but let's take it even further. When are the 10 best days? They're directly after the 10 worst days. So if the market goes down 10% in a day, most likely shortly thereafter, the market's going to rebound really quickly, which means the best days follow the worst days. So if you go back and look, and this is why I always tell people, look at charts, look at a stock chart, look at history, look at the last 100 years of the index, and look at the worst days. The best days follow the worst days. So if you miss both of them, you'd be fine. You'd be getting, but the problem is that's not what happens. What happens is you get a crash, you get a crack up, boom, or you get all this stuff that happens. You get the tech bubble, on the upside and then bursting on the downside. You get COVID events, you get 2008, you get all these events where things go down rapidly and up rapidly. And everyone's like, oh, you can't miss the 10 best days or 10 worst days. It doesn't matter. The idea is just, if you're going to stay in the market long term, stay in the market, right? If you are concerned about losing, and you should be if you're buying at the top. So if you're buying at an expensive time, and we are in an expensive time, just like the late 90s, just like now, just like right before COVID, there are a bunch of times where the markets were really expensive. While the markets are expensive now, they've been expensive actually for quite some time. So it doesn't mean they can't stay expensive. But when you're buying when the market's expensive and you're overpaying for something, if you're paying for a stock with a 200 PE, that means the earnings will take 200 years to earn back that money, which means you're not going to make your money back for 200 years. So at some point that stock's either going to crash or it's going to continue to grow so it catches up to that PE. If you want to bet on that, good luck to you. But the risk is high that it won't, right? And that it'll take a long time to catch up to the price you paid. So if you overpay, it just means it takes longer for you to make your money back. So I just wanted to point that out because people kind of miss out on the fact that the upside and downside are typically related. If you look at the VIX, I'd recommend anyone. Let's see. Well, I can't share the screen at the moment, but if you look at the VIX, let me see if I can bring it up here. See if I can share it. All right.
The VIX is the volatility index. So for those of you that don't know what that is, that kind of gives you a barometer to understand the degree of ups and downs.
All right. Here's a quick chart on the VIX. Okay. And as Barb said, it's basically the volatility index. It measures volatility. So here is an example of the last, this doesn't go back that far, it goes back 2005. So this is basically the VIX. When it's high, it means there's fear in the market. When it's low, it means there's no fear. It means there's complacency. So if you look at COVID, it hit basically an all-time high, I think it was all-time high of 80. That was really high, right? If you look back in 2008, it didn't get that high. It only got to 70 or just tick 70. So if you look at the times where it peaks, when it peaks, people are freaking out, right? And it gets expensive to buy fire insurance when your house is on fire. But in times like this, it's a better time to buy fire insurance, right? So you need to understand how this works. But the point is this is history of when people freak out. This is the freak out index, as I think of it. So this is when people freak out. Now, if you look at it, obviously, most times it's not. Most times it's within this range, but sometimes people freak out. And so you just need to be mindful of the fact that that's what's going on. That's how the market reacts. And based on, based on how many people are freaking out, the insurance of your portfolio or the risk management tools or hedging or whatever you want to call it, those tools get more expensive. So you want to do it when it's cheap, not when it's expensive. Right now, it's starting to pick up as of the last, I guess this is a monthly chart, as of the last few months. Since pretty much July, August, it kind of bottomed and it's starting to creep up. So just something to keep in mind. It's not that bad right now. There was a bad period when people were worried about Japan, but since it's been relatively low. But if some bad things happen, that could pick up, and then you just want to be aware that that's an index to look at for risk.
I want to talk about also how you can look at the worst case scenario for your portfolio. I don't know about you, but I like to have a certain degree of understanding of what might happen. Now, I'm less concerned about the good side and more concerned about the worst case scenario. So, on occasion, it's a good idea to look at your overall asset allocation of your portfolio, which means pretty much your stocks to bonds to whatever asset classes. Look at the percentages and then do I call it a pre-mortem. It's a worst case scenario. So let's say you're 80% in stocks. What would happen if that portion of your portfolio dropped 35%? And let's just hold the rest constant. And that gives you an idea of how low your investable portfolio could possibly fall. And ask yourself, are you going to be tempted to sell at the bottom? Because as we all know, selling at the bottom is a bad idea. Because then you don't know when to get back in and you're likely going to miss the upside. And if the answer is yes, I could not tolerate a 35 or even a 40% drop in the equity portion of my portfolio, then you might want to consider rebalancing your assets so you hold a little more of cash and fixed assets, which in most cases, 2022 aside, will help temper the downward volatility of your portfolio.
Yeah, I agree. So we're going to wrap it up here. So final question for you, Barb. So how should people be thinking about, protecting themselves? So this episode is obviously about stock options, which, doesn't impact everybody, but if you have stock options, obviously you want to think about how to manage your risk. And as we talked about in the show, managing risk in the case of stock options or restricted stock is, should I invest my own money into my stock options because it'll give me a better outcome, which of course increases your risk. Because if you're granted stock options, it's basically free money, right? They're giving it to you, and what you do with it is up to you. You have a few choices, which we talked about on the interview. But sometimes a better outcome means investing cash, which of course is higher risk because you're putting your own money in, as opposed to just taking free money from the company. But So there's definitely some methods you could do to manage your risk around those positions. But what about outside of diversification? Like, how should people be thinking about this? You mentioned before the show. I know there's some ETFs out there now that actually have these weird strategies to help manage risk. Is that something you'd recommend people consider, or should people just be thinking about plain Jane, indexing?
The ETFs that Kirk's referring to are ETFs that have call options embedded in them, which means they are designed to limit the downside risk on your amount invested with that ETF, but it'll also limit the upside risk. So most of these are newer products and they are legitimate strategies. So I don't know that many of these ETFs have enough history under them to tell if they work the way they are designed to work. So that's one question that I would ask. But their premise is legitimate if you're willing to sacrifice a certain amount of upside to limit the downside. So I would say they're worth considering. I'm not going to go you should or you shouldn't invest in them, but I'd say they're worth looking into. But your asset allocation is very important. And there's research that has said the total long-term impacts of your investment portfolio are more driven by your asset allocation, which means your percentage of stocks to bonds, than it is by the individual holdings. So investigate what your comfort level is with volatility. Design your portfolio in a way that manages your personal risk comfort level. So even if you're in your 40s, but you are very risk averse, you don't like big declines in your portfolio, you might opt to have a 60 stock, 40 bond investment portfolio. If you're more risk tolerance, 80 stock, 20 bond, 90 stock, 10 bond. And although this is rarely discussed because financial advisors make no money when you're holding cash, owning a certain percentage of cash, which over the long term, the purchasing power is likely to be eroded by inflation, but it also helps stabilize the dollar value of your portfolio. So these are big questions. If you have company stock, don't allow it to become too big a percentage of your overall investable portfolio because you are setting yourself up for a big risk if the company falters. So I am Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and also on my YouTube channel. See you next time.
Great. Well, thanks for coming on, Barb, and sharing your wisdom with us.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.